Okay. Good evening, everyone. Good morning, good afternoon, people in different jurisdictions. This is Divya Baveja, and I have with me Mr. Vishwanath. Thanks for joining us for the webinar. So in next 1 hour, we will take you through a snapshot of the Union Budget 2014, which was presented by the Honorable Finance Minister, Mr. Arun Jaitley. Broadly, what we plan to cover in this presentation of 1 hour will be a snapshot on the recent economic performance, certain policy measures which were announced by the Honorable Finance Minister in the budget, certain tax proposals, and then we will have some time for question and answers also, where we will address your queries. So looking at the state of the economy, so if we look at the recent economic performance, a quick summary. So we have seen there are certain ups and certain downs. So as everyone says, let's start with the ups first, the good things. The trade deficit and the current account deficit has improved considerably. The trade deficit contracted by 42.4% in May 2014. If you look at the fiscal deficit, that was contained within the target of fiscal consolidation, which was at 4.5% for 2013-14. The target is to achieve a rate of 4.1% in the current financial year. It looks optimistic, but I hope we are able to achieve that, considering that we have achieved 4.5. Sensex has been stable at all-time highs. Before the budget, we saw Sensex peaking up to 26,100 in July 2014. Foreign fund inflows have experienced a surge. So when we compare quarter by quarter, if you look at the quarter 4 of financial year 2013-14, the net FI inflow was about 9.5 billion USD. Coming to the downsides, we all know what the economy went through over the last couple of years. The GDP growth has been sluggish in last 2 years. The growth was about 4.7% for 13-14. Though what we are looking at, or the finance minister is hopeful that we will be able to achieve about 5.4 to 5.9% in coming years. The inflation has been a matter of concern, mainly when it comes to fuel and food. So the consumer price index is at about 8.3% in May 2014. The good news is that in June, if you look at it, it went down to 5.43. So that's what it looks like. The rupee has depreciated significantly despite recent stability. So it hovers around 60 against the US dollar in 2014. Stringent monetary policy measures were taken due to high inflation, which were impeding growth. So key policy rate is as high as about 8%. So if we look at the snapshot of the economy, there have been certain ups and downs. So the finance minister's budget, or the presentation that he made, was catered towards meeting the economic scenario and see how well best we can move towards the path of stable growth. Coming to the significant policy proposals, clearly, there has been a focus on foreign direct investment. If we look at insurance and defense, there has been a demand from the industry to increase the FDI in both these sectors. Currently, it is pegged at 26%. The finance minister, the proposal is to have a composite cap of FDI to be increased to 49% where insurance is concerned, with approval through FIPB, which is the body which grants all the foreign investment approvals, with a condition of full Indian management and control. The Insurance Act would need to be amended through the approval of Parliament for this purpose. Coming to defense, defense has been very close to the current government. So there's a composite cap of FDI proposed to be increased to 49% from 26%. Again through the FIPB route with full Indian management and control. There has been a lot of focus on construction and development projects also. The finance minister talked about smart cities, and the FDI conditions which were relaxed for smart cities are a built-up minimum area requirement, which is there for non-smart cities, 50,000 square meter, has been reduced to 20,000 square meters. The capital requirement has been reduced from USD 10 million to USD 5 million. And projects which commit at least 30% of the total project cost for low-cost affordable housing have been exempted from minimum built-up area and capitalization requirements as mentioned above. The good thing is that when we look at the requirement of 50,000 square feet or 20,000 square feet or 5 million USD, these limits are not applicable for any investments which are made by NRIs in construction and development projects. Coming to certain focus sectors, I think manufacturing is the key for any growth and to achieve the desired growth rate in economy. So manufacturing entities with FDI will be allowed to sell products through retail, and even e-commerce platforms will be permitted for such purposes. When we look at micro, small and medium enterprises, there is a proposal to review the definition of MSME so as to provide a higher capital ceiling, which will definitely give a boost to the MSME sector. Infrastructure remains the core of every economy's growth or every country's growth and development. There is a proposal to look at REITs, which are real estate investment trusts, and a modified REIT type structure, which is infrastructure investment trust that will be focused on infrastructure. Now there is a proposal to set up REITs and IITs, which is what infrastructure investment trusts are, to attract long-term finance from foreign and domestic sources, including from NRIs. Now if we look at the current FDI norms, they restrict any investment, a foreign investment in trusts, except for when we look at a venture capital trust. So it seems that the FDI norms would need to be amended so as to allow foreign investment in REIT and infrastructure investment trusts. There is a lot of talk of encouraging public-private partnership models. This is something which is going to be really helpful, where you invite private participation in certain projects such as infrastructure for urban transport, such as metro rails or light rails, airports, gas, pipeline. The only thing is that when we look at metro rail and light rail, these are intra-city rails where FDI is permitted. There is also talk about promoting townships and developing about 100 smart cities. Now which will be these cities, those announcements will come subsequently. The focus of government will also be to encourage industrial corridors and expressways such as Vizag, Chennai, Bengaluru. So we see a lot of focus on infrastructure by the current government, which is clearly the need of the hour. Other focus sectors when we look at, clearly textile. The government proposed to set up 6 more textile mega clusters in Bareilly, Lucknow, Surat, Kutch, Bhagalpur, Mysore and in Tamil Nadu. Tourism remains of prime importance. There is a proposal to develop 5 tourist circuits. There is a proposal to introduce facility of e-visas and also facilitate visa on arrival for certain countries. For which all countries will it be applicable will remain to be seen as time passes. There was a concern that when you have visa on arrival, how do you look at from a safety perspective? Those issues would need to be addressed as we proceed on the visa on arrival facilitation. Special economic zones they've been enjoying tax holidays, and there is a commitment by the government to revive SEZs. They had not seen as much investment as was envisaged when they were set up. Clearly there are certain tax exemptions and holiday benefits which are available when we look at SEZs, be it a developer or be it a unit. So there's a commitment to revive SEZs and make them effective instruments for industrial production, economic growth, export promotion, and employment generation. And employment generation has been again one of the key focus areas of the current government. First time the government is also looking at setting up an NRI fund for Ganga to be set up, which will facilitate special projects. The details of this fund are yet to be finalized or yet to be disclosed and declared. Coming to certain tax policy reforms or tax administration, there has been a lot of debate last year, a lot of anxiety in the industry on the tax administration, especially with respect to retrospective amendments. In the speech given by the finance minister, he clearly committed to providing a stable and a predictable tax regime that would be investor friendly and that would spur the growth. I don't need to talk much about retrospective amendments. I think everyone knows about it. So there has been a commitment that not to ordinarily bring about retrospective amendments which create a fresh liability. Insofar as cases where retrospective amendments are to be made, so instead of tax officers, a high-level committee is going to be set up which will scrutinize indirect transfer cases which are covered by retrospective amendments. Now these are the cases when we look at whether it's Vodafone or certain other large corporates where a lot of litigation is happening on these indirect transfers. So this is a positive move to set up a high-level committee. Who will comprise a part of this committee is yet to be announced, and I think will be declared or will be announced shortly. Direct taxes code, an attempt was made to set up a simplified tax regime. The comments were invited from the stakeholders. There was also a task force which was set up to give comments on the direct taxes code. The government will consider comments received from various stakeholders, review the provisions, and take a view in the whole matter. The finance minister was honest enough in saying that given that they were there for only 45 days, they need more time to review these provisions more closely so as to comment on this and to see how to take it forward. Clearly, what we have seen is a lot of money is held up in tax disputes. So there was clearly a requirement for measures for certainty and to bring about clarity in tax laws. So certain steps which have been proposed are, extending the scope for authority for advance rulings. Currently, it was restricted to only transactions proposed or undertaken by non-residents or PSUs. So it has been extended to resident taxpayers so that they can obtain a ruling which can then be binding and that can help in reducing the litigation. Additional benches are proposed to be constituted so as to make this more effective. A high-level committee is proposed to be set up which will interact with the trade and industry bodies so as to ascertain the areas where clarity is required. Appropriate clarifications are expected within 2 months. There was a lot of expectations from the industry in respect of general anti-avoidance rules, commonly known as GAR, and there was an expectation that whether the kickoff date will remain April 15 or will it get pushed to April 2016. No policy announcements or amendments had been made in relation to the applicability of GAR, whether it will be 15 or 2016. The finance minister did indicate subsequently that he is going to be looking at these provisions more closely before they come out with any kind of a clarification or a declaration to this effect. There have been significant changes made in transfer pricing regulations, primarily looking at the disputes which are there, considering that a lot of money is locked up in transfer pricing disputes. I will cover some key changes subsequently. Coming to tax proposals, tax rates. there was a lot of expectation by people that the minimum threshold limit will go up from 2 lakhs to 3 lakhs or 5 lakhs. But considering the state of the economy, the situation we are in, I think the finance minister did give a modest increase of 50,000. So this increase of 50,000 applies both for residents, non-residents, and also for senior citizens. The category which has been left out is very senior citizens who are of the ages 80 years and above. So if we look at for resident and non-resident individuals, the basic minimum threshold limit goes up from 2 lakh to 2 lakh 50,000 or 200,000, 250,000. For resident senior citizen from the age of 60 to 79, the limit goes up from 250,000 to 300,000. There has been no change in other tax slab limits as well as tax rates. The tax rates for corporates remain the same, so there is no change in that. There was a long-standing demand from the taxpayers, individual taxpayers, that the limit for deduction of interest on housing loan in case of self-occupied house property be increased. This limit, which was pegged at 150,000 for few years, has been increased to 200,000 from current financial year. Now NRIs can take home loan in India subject to terms and conditions specified in FEMA deposit regulations. So we would need to look at that, but this deduction is still applicable. Coming to capital gains, this is something, the change which I am going to talk about in terms of unlisted securities or debt oriented funds has been close to a lot of people's heart, and this is something where substantial change has been made. The holding period for unlisted shares and debt oriented funds has been increased from 12 months to 36 months for the purpose of determining long-term capital gains. And also earlier there was a provision of having a benefit of 10% tax rate without indexation and a 20% tax rate with indexation in terms of long-term capital gains for debt-oriented mutual funds. Now the benefit of 10% is not available, so as a result any capital gain arising out of debt-oriented mutual funds, any long-term capital gain will be taxed at 20% with indexation. Representations were made to the finance minister post this budget, and the finance minister has said that he would review this position, especially presentations were made by various funds, so as it would have an impact on the funds investments. So this provision, the finance minister says he would review it, so what comes out finally is yet to be seen. The transfer of government security from one non-resident to another will be exempt, subject to the condition that the government security should carry a periodic interest. The transfer should happen through an intermediary dealing in settlement of securities, and the transfer should be executed outside India. In terms of capital gains exemptions, there have been some changes in exemptions insofar as reinvestments of long-term capital gain is concerned, or a reinvestment of net sale consideration is concerned in case of a residential house. The sections which provided for such an exemption were silent in terms of the number of houses an individual could invest in, as well as the place where such property could be situated. So it has been clarified that exemption will be available for investment made in one residential house situated in India. So this settles the disputes which were going on earlier, where there were various judicial pronouncements which said that if you have two flats at the same level, at the same floor, you could take them as one unit and claim the benefit. So all the rulings which were pronounced in such cases will now not hold good anymore going forward. The provision of reinvestment of long-term capital gains or in sales proceed in specific bonds, there was some kind of an ambiguity. The law earlier provided that in case there's a capital gains, long-term capital gain, the taxpayer could invest 50 lakhs in a financial year and in the subsequent financial year subject to a total period of 6 months. So for an example, if I sell a property and I make a gain on 1st January 2014, I had a window of 6 months to make investment in these specified bonds. So as per the law which was prevalent earlier, the taxpayer could make 50 lakhs investment in these bonds for the period, say Jan 1 to 31st March 2014 in this example, and 50 lakhs in the financial year starting from April 1, 2014. So as a result, they were taking a benefit of almost 100,000 rupees, 100 lakhs. So with this amendment taking place, the benefit will get restricted to only 50 lakhs instead of 100 lakhs. Coming to deductions, the limit for deduction in respect of specified payments such as life insurance premium, mutual funds, contribution to provident fund has been enhanced from 100,000 to 150,000. One more category which is there which falls as a qualified investment is contribution to public provident fund, where the limit has been increased from 100,000 to 150,000. I'm not going to talk more about it because NRIs are not permitted to invest in public provident fund. But yes, they could take the benefit of investment in mutual funds or life insurance premium, or in case there are people who are salaried and working overseas, they can contribute to pension funds in India, where the limit has gone up from 100 to 150,000. Coming to withholding tax, the life insurance proceeds which in respect of payments received under life insurance policy, which were not exempt under specified section 1010D, we have given what 1010D is below. There the income was taxable, but there was no way of catching the people who were getting this income and offering it to tax. So because it was earlier an advanced tax mechanism, there were cases where the people were getting such payments and not offering it to tax. So to plug that, a withholding tax rate of 2% has been imposed with a threshold limit of assessees earning income of more than 100,000. And this payment will include sums allocated by way of bonus also. There is a concessional tax rate of 15% on dividends received from specified foreign companies, which was applicable only for last year, has been extended indefinitely. So if an Indian company sets up a subsidiary overseas and receives dividend, there will be a concessional tax rate of 15% on such dividends. Now certain other changes. There has been a significant change in the manner of calculation of dividend distribution tax. The dividend to be grossed up for the purpose of payment of different distribution tax with effect from April 1, 2014. So I'll not go into this calculation, but I'll simply the dividend distribution tax, which was earlier much lower, has now increased by virtue of this change of the method of calculation of dividend distribution tax. And now if you look at a comparison for an Indian company and for a foreign company, we'll see that the maximum rate for a foreign company is 43.226%, which is around 2% lower than the effective rate for an Indian company when we look at the tax which an Indian company pays plus the impact of the dividend distribution tax. Other key changes which are there, some positive, some negative. Clearly, as I mentioned earlier, there is a desire to promote manufacturing sector. So as a result, there's a proposal of allowing investment allowance for manufacturing companies, which has been relaxed. There is a proposal to reduce the threshold limit of investment to 25 crores and extend this benefit till 31st March 2017. Infrastructure has been core to the government's heart. The sunset date for tax holiday for power sector, which was to end on 31st March 2014, has been extended by 3 years to 31st March 2017. The new Companies Act 2013 makes it mandatory for corporates to spend on corporate social responsibility. The budget prescribes that only certain expenses towards corporate social responsibility would be allowable as an business expense and deductible, and certain expenses will not be allowed as deductible. Earlier, a position was being adopted that such expenses could be allowed as deduction under a residuary section, which will no longer apply going forward. The investment-linked tax incentive has been extended to slurry pipeline for transportation of iron ore and for notified semiconductor water fabrication manufacturing units. There is a concessional tax rate of 5% on overseas borrowings. Now, in case where NRIs are concerned, we will have to look at external commercial borrowing regulations to see where it applies, and then accordingly in such cases this rate could be applicable. As I mentioned earlier, the focus area or important proposal which the government has made is in terms of real estate investment trusts. There is a special taxation regime which has been proposed for REITs and infrastructure investment trusts, InvITs as they call it. So when I look at a structure of a REIT, we have a sponsor who holds certain assets, and he transfers those assets to the REIT, and REIT in turn uses those assets or transfers to the SPV. There are certain units which are issued by the REIT to the sponsor, as well as to certain foreign investors as well as Indian investors, and these units are listed on a stock exchange. So how does it all work, or what does it mean from a tax perspective, whether it is a REIT or whether it's an investor, or whether it's a sponsor or an SPV? To make it very simple, if we look at a REIT, any interest and dividend which REIT receives from the SPV will be exempt. The SPV will of course pay dividend distribution tax. Any capital gain which is realized by the REIT on sale of these units will be taxable at applicable rates, and any other income which is earned by the REIT which is other than interest or dividend or capital gains will be taxed at the maximum marginal rate, which is 30% plus surcharge and cess as applicable. Insofar as SPV is concerned, it's a company, so whatever it will be taxed in the normal course, so there is no special tax treatment where an SPV is concerned. Looking at the investors, so since these units will be listed on stock exchange, the sale of these units will be liable to securities transaction tax. So correspondingly, any long-term capital gain on these units will be exempt. The short-term capital gains will be taxed at 15% plus surcharge and cess as applicable. Any interest which is received by the investors will be taxed at 5% for overseas investors and withholding tax at 10% for Indian investors. When I talk about 5%, there will be a plus in terms of cess and surcharge as applicable. Any dividend received by the investors will be exempt. Any distributed income will be attributable to capital gains in the hands of trust will be exempt. Looking at the sponsors, any capital gain arising to the sponsor on exchange of shares in SPV will be deferred till the disposal of units of the REIT by the sponsor. The preferential capital gain tax treatment will not be available for units acquired pursuant to exchange, and the cost of shares will be regarded as the cost of the units which the investor gets. And the period of holding of shares by the sponsor shall be included in computing the period of holding of the unit when we look at whether it's a long term or a short term. So when we look at the summary, if the nature of income is in the form of interest, then it is exempt in the hands of the REIT. It is, however, taxable in the hands of investors. Dividend is exempt whether it is in the hands of REIT or the investors. However, DDT will be payable by the SPV. Any capital gains on transfer by REIT or the trust will be taxable in the hands of the REIT and exempt in the hands of the investors. Transfer pricing. As I had indicated earlier, there has been a lot of dispute on transfer pricing issues, and a lot of amounts, a lot of funds have been locked up in the transfer pricing disputes. The government had proposed advanced pricing arrangements last year with the purpose to agree on the markup with the authorities so as to minimize litigation. It has been proposed in the current budget that in case an APA has been entered into and agreed upon with the authorities, then it can be rolled back 4 years for the same entity which is seeking an APA so as to minimize litigation. The scope of deemed international transaction has been extended to even cover cases involving third parties, even if a third party is an Indian resident. The finance minister in his speech also proposed amending the following, coming out with a range concept for determining the arm's length price. The purpose of this was to make sure that all the extremes, whether it's extremely high or extremely low ranges, they get eliminated and we can arrive at a more realistic arithmetic mean or a arm's length price. The usage of multiple layer data has been permitted, and the detailed rules in respect of the above will be subsequently notified. Coming to the last leg of our presentation, there have been certain key policy announcements insofar as indirect taxes are concerned. I'll not be dwelling into specific amendments made on service tax, excise or customs. So I'm just going to focus on certain important policy announcements. There has been a lot of debate on GST in the past. So the finance minister did say that the discussion on GST is expected to culminate by this year, and there's a reasonable assurance of states getting a fair deal and therefore it coming implemented soon. The SEZ scheme would be revived to attract investment. A high-level committee is proposed to be set up under the Central Board of Excise and Customs to clarify pan-industry issues within a period of 2 months. And there is also a proposal for single window clearance to facilitate importers and exporters to file their clearance documents at a single point. So these are certain important policy announcements from the indirect tax perspective. That brings us to the end of today's presentation. We'll be happy to take questions and address the queries that you... Mr. Vishwanathan, you want to add something?